Hey, it's OG John AG here. The price of silver in the West is sitting at 8,850 right now, as I'm recording this. Silver futures in the West are at 88. Even over in Shanghai, the spot price came in at 86. Shanghai futures are also at 88. And tonight, for the first time since the Chinese New Year holiday, the Shanghai futures market is opening back up. In the last video, we talked about what that moment might look like. Well, it's finally here. Silver got pushed down hard multiple times today. It got knocked back down to the 85 range more than once. But both times it bounced back up. It's now back up to 8,850 on Western spot prices. That tells you something important. When a price keeps getting pushed down but keeps coming back up, you're not looking at a weak market. You're looking at a market where the people buying underneath are serious and real. Gold is sitting at $5,228 in Western spot prices. Just 2 trading days ago, both metals were noticeably lower. Over those 2 days, gold went up about 4%, and silver shot up over 11%. Bitcoin over that same time actually went down. Now, for people who watch prices closely in the short term, what I'm about to share is strictly for learning purposes. It is not a signal, not advice, and not me telling you to do anything. This is for people who want to learn how price structure and candle closes work in real life. In the last video, we clearly mapped out the resistance zone, which is from 8,720 all the way up to 89. The price is sitting inside that zone right now. We haven't yet seen an hourly candle close above it. That matters a lot. Hanging around inside a resistance zone without breaking through it gives the people betting against silver time to set up their positions again. What this market needs, if the bullish story is going to play out, is a strong close above 89. Not just a quick spike up, not just a tiny touch, but a real candle body close that proves that zone is no longer a ceiling. If that happens, 90 is the next big level to watch, then 92, and the door opens for the price to keep going. Until that close happens, that zone is still doing its job as a ceiling. Watch the hourly chart, and watch the candle body. That's the lesson here. And if you're learning and getting value from this, drop OG John AG in the comments. 3 words, and I'll know you're paying attention. Now back to the bigger picture, because the structural story underneath all this price action is what really matters. Silver's COMEX implied volatility index broke above 100 again. Think of this like a fear meter for the silver options market. When it's low, traders expect things to be quiet and calm. When it spikes this high, the options market is basically saying it expects big, possibly messy moves coming up. It doesn't tell you which direction prices will go. It just tells you the structure underneath is under a lot of stress. And after the last video where we talked about the naked short problem and how forced liquidations work in commodity markets, that stress has a very specific source. March silver open interest, just 3 trading days before first notice day, is still sitting at 44,500 contracts. That represents over 223 million ounces of paper silver. Open interest did drop by around 3,300 contracts on Friday, but the amount still left heading into first notice day is really significant. Most of those positions will either roll over or close without anyone actually asking for physical silver. That's just how the paper market works. But every single contract that doesn't roll over becomes a demand for real physical silver delivery. And COMEX February silver deliveries have already reached 23.5 million ounces this month. The physical delivery pipeline is very much active and moving, and then there's the pressure coming from the Shanghai side of things. We talked about naked shorts in the last video. Beyond Zheming is the name behind the biggest one. He's a Chinese billionaire who is holding a 450 metric ton short position on the Shanghai Futures Exchange. But the total silver inventory on that whole exchange is only about 350 tons. His short bet is bigger than all the physical silver actually sitting on that exchange. Regulators have frozen his ability to add more to his position and raise the margin requirements on him. Can he hedge his position? In theory, yes, but at this massive scale with no physical silver as a buffer and cross-exchange capital requirements to deal with, getting out of this position is not going to be clean or easy. The exchange reopens tonight. Watch closely. Adding even more pressure to the situation, on Friday alone, 2.25 million ounces were drained out of COMEX silver warehouses. CNT, Delaware, HSBC, and JP Morgan all saw withdrawals. Total COMEX silver inventory is now sitting at 364 million ounces. The drain is not slowing down. The physical silver is leaving the building. Peak global silver production was back in 2016. We're not expected to get back to that level until 2030. Meanwhile, industrial demand has grown from 47% of total silver use all the way up to 67%. Solar panels, electric vehicles, data centers, defense, electronics, all of it needs silver. Supply just hasn't kept up with all that demand. The market has run deficits for 5 years in a row. The paper price still hasn't caught up to that reality. That's the core of the structural problem. Quick Mexico update. Because we covered the basics in the last video. Elro is gone, roads are blocked, mines are shutting down, cartels are extorting shipments in the affected regions. Mexico supplies roughly 45 to 50% of all silver the US imports. The risk exists on paper right now. Whether it actually turns into a real supply disruption is still an open question. What's new? Trump publicly offered to send US military into Mexico to take control of the cartels directly. His exact words were, "If Mexico wanted help with the cartels, we would be honored to go in and do it." That is not a small statement at all. Whether it actually happens or not, it signals that the situation has gotten serious enough for the US government to openly talk about military action. For a country that produces 1 out of every 4 ounces of silver mined globally, that level of instability and geopolitical mess is a supply risk that the mainstream world is not factoring into the paper price. Keep watching this space. On the geopolitical side, the tariff situation has not calmed down either. Trump threatened significantly higher tariffs against the EU in response to their move to freeze the ratification of a trade agreement with the US following a Supreme Court decision. He's been very clear about it. The US will hit harder than before if countries try to play games. That framing matters because it puts trade war escalation risk right into global investment decisions happening in real time. And separately, US military hardware in the Middle East is still sitting at elevated positioning levels. The Iran situation hasn't been resolved, it's just paused. Pauses with that kind of military buildup don't always stay pauses. Now look at what's happening in the broader markets at the same time. Anthropic launched Claude Code, and the ripple effects on specific sectors have been really significant. Cybersecurity stocks saw over $52 billion wiped out in just 2 trading sessions. CrowdStrike dropped 20%. Cloudflare dropped over 18%. IBM fell 10% on the news that Claude can now convert legacy COBOL code directly, which goes right at the heart of IBM's core business of modernizing old systems. These are not small moves for those sectors. And Bitcoin fell below $64,000 today as leveraged positions got liquidated and accelerated the fall. This matters for the metals story because of where that capital is going instead. Gold added over $500 billion to its market cap in a single hour earlier today. Silver added roughly $130 billion in that same window. When paper assets like stocks and crypto are under pressure and hard assets are surging at the same time, you are watching a live, real-time decision about where to put money being made at a massive scale. And then there's the AI economic risk layer. This one connects to the metals story in a way most people haven't really stopped to think about. AI is not failing, it is working, but it is working faster than the traditional job economy can adjust to. White-collar workers make up roughly half of all US employment. The top 20% of income earners are responsible for over 60% of all consumer spending. If AI tools keep cutting the cost of tasks that high-income, smart workers used to do, software development, security analysis, code modernization, and that job displacement happens faster than new high-paying jobs are being created, you end up with a wage-based economic slowdown that feeds back into housing, credit, and government tax revenue all at once. That's not a prediction. That's just a logical chain of events worth tracking really carefully. This is not a guarantee that everything falls apart, but it is a structural risk that puts more pressure on the dollar, more pressure on government deficits, and more demand for assets that don't rely on anyone else keeping their promises. That is the exact environment where metals are built to outperform. The displacement loop goes like this. AI gets better, companies cut costs, consumer spending weakens, companies protect their profits by buying more AI. That cycle is deflationary for workers' wages and inflationary for hard assets. You don't have to fully believe that whole scenario plays out to recognize that investors are already pricing in that possibility right now. The capital flows are saying it out loud and clearly. Meanwhile, Chinese investors have been buying gold ETFs at a pace the World Gold Council described as historic. Chinese gold ETF holdings rose 52% between late August 2025 and the end of January 2026. That is not just small retail noise. That is big institutional money and regular retail investors in the world's second-largest economy moving into gold at a record-breaking pace during a time when both geopolitical uncertainty and questions about their own domestic economy are running high. And the GSR, the gold-to-silver ratio, after being stuck somewhere between 80 and 100 for years, dropped all the way down to 44 to 1 when silver spiked to $120 on January 26. We're now back around 60 to 1. That ratio compressing from 100 down to 44, and now settling in the 60s, tells you something has changed in how silver is behaving compared to gold. It is no longer the chronic underperformer it was for most of the past decade. Now here's the honest case for being cautious, because that's what this channel is about. The COMEX implied volatility spike cuts both ways. High volatility means the market is pricing in violent moves in either direction, not just up. A coordinated move by large institutional players or a liquidity crisis in another asset class could push silver sharply back down in the short term, even if the bigger structural story stays intact. Shanghai reopening tonight could open with more caution than the physical demand signal is suggesting. If Chinese institutions look at the gap that formed during their holiday absence and decide to be measured and careful in how they respond, and the Mexico supply disruption, while pointing in a concerning direction, has not yet shown up in confirmed mine output data, the risk is real. But the confirmed real-world impact is not yet there. Mark Douglas made this crystal clear. Even your best, most perfectly set up trade can still lose. The edge isn't about being right on any single trade. It's about playing the probabilities correctly over a long stretch of time. Right now, the fundamental case for silver is as strong as it's been at any point this whole cycle. But when exactly the price catches up to the fundamentals, that's always the unknown. Anyone giving you an exact date is guessing, not actually analyzing anything. Bottom line, two big things are coming together at the same time. A physical silver market that is structurally tighter than the paper price is reflecting, with documented supply pressure from Mexico, active COMEX delivery demand, warehouse drains that are speeding up, and a Shanghai futures exchange reopening into a significant price gap with forced short covering on a clock in a macro environment, with tariff escalation, AI-driven labor displacement risk, and capital rotating out of stocks and crypto that is actively hostile to paper assets and very friendly to hard ones. Both of those forces are pointing in the same direction. The open question isn't whether the structural case makes sense. It's whether tonight's Shanghai Open confirms what the physical market is already pricing in. That data will be available in just a few hours. Go verify it yourself. This is financial education, not advice. Protect your capital. Do your own homework. Don't just take my word for any of this. The CME reports, the World Gold Council data, the Silver Institute supply and demand figures are all publicly available and you can check them yourself. Invest with logic, not hype. OG out.